Cautious New World Order with Arnab Das. My name is Kenneth Damien, and I'm the chair of the LSE Alumni Association London. And this event is brought to you in collaboration between the LSE and Kellogg University. We're also joined by several of our friends from other institutions, including LBS. Just a quick bit of housekeeping. The order of events is that once we hand over to Arnab, he's got a set of slides and he'll take us through his thesis on the subject matter. We'll then have a Q&A section at the end for half of the scheduled time. You can raise questions in the Q&A feature at the bottom of your screen, and we'll be collating those to put to Arnab at the end. And the event will be recorded, but it is kind of pending final sign-off from Arnab's side. As Arnab has very kindly given up his time to be with us today, we should note that he can't give investment advice directly, but he'll be very happy to do his best to field kind of general queries and perhaps sector-specific discussion points. I'm now going to hand over to Gina Mock, who's the director of Beyond Business, to say a few words, and then we'll kick things off.
Hi, I'm Gina Mock, and I'm one of the co-hosts today. And Beyond Business is a collaborative network that includes alumni clubs and professional organizations. We have here our friends from the Kellogg Alumni Club, and we have friends from London Business School, Wharton, Columbia, Brown. I can't give a shout out to everybody, but you're there, and we really appreciate your collaboration, your participation in this event. Without much ado, I'll hand it over to Arnab to do this presentation.
Okay, well, thanks very much, Gina and Kenneth, for setting this up, and thanks everyone for giving up part of your evening to share this discussion. So as Kenneth said, I'm going to talk you through a presentation that is kind of an update of a presentation we use with institutional clients all over the world to talk about the pandemic, how to think about the economic impact, particularly of the lockdowns rather more than the pandemic, and how to think about the shape of the recovery. So maybe before I launch into that, I'll just set the context a little bit by saying that I've been with Invesco for several years, since 2015, working on emerging markets and global macro, global economics and strategy across asset classes. So I don't work with any particular investment team, right? They keep me as far away from the actual money as possible. But I interact with a lot of the investment teams, a lot of our professional institutional clients around the world, a lot of governments and central banks, sovereign wealth funds, and so on. Before I joined Invesco, I worked at a few different investment banks, also worked with a notorious economist called Nouriel Roubini. Nouriel is famous for having predicted, among other things, having predicted the global financial crisis, for which he was known as Dr. Doom. He wrote a paper in 2007, I think it was, called 12 Steps to Financial Armageddon, kind of a blow-by-blow description of how the US housing bubble was going to burst. Two small anonymous US investment banks were going to go belly up. That was going to bring down the housing finance system in the United States, bring down the overall financial system of the country and then the planet, and put us into another global Great Depression. Of course, it didn't quite turn out that way, but that's what he was famous for. So after the GFC, I threw in my lot with Nouriel for a while. And I was known as Deputy Doom. I like to think because we sort of tried to call the Eurozone financial crisis together. So a lot of crisis stuff that I've done in my career in the past. But I have to say I'm an optimist by nature. And so I'm going to try and walk you through some of the grim story of the pandemic that I'm sure everyone is reasonably familiar with, but just a level set, talk about that. Talk about what I call the Great Compression. I think this is not at all like a recession or a depression because, in effect, we've pressed an economic pause button that's caused a kind of recession in fast forward and a financial panic in reverse. So very different than what we're used to seeing in domestic economies or in the international system. We talk a little bit about the long-term outlook for geoeconomics and geopolitics, the international system sort of over the horizon, and then try to bring all that together to think about the path of the recovery. I call it a square root recovery in this whole alphabet soup of V's and W's and L's and U's that everybody talks about. And then conclude with kind of an outlook for the global economy based on a toy model that we've made, and I'll try to describe that to you. So there's a lot of material here. I'll zip through some of it and spend more time on other parts of it. So here, this is a slide taken from a paper published around the Ides of March, around the middle of March, commissioned by Number 10 and the UK government, and shared immediately with the US White House Coronavirus Task Force, that effectively flipped around the policy in the US and the UK to being largely what the policies were in many other parts of the world, particularly China and continental Europe, in effect to go for societal, economy-wide lockdowns. And the logic here was that if you had an unmitigated epidemic based on transmission rates observed primarily in Wuhan City and Hubei province in China, you would see deaths on pars in the United States and the United Kingdom on par with major wars that would overwhelm your public health capacity and even any kind of surge capacity that you might have, right? So that it was essential to do these lockdowns. And the logic of the lockdown was to try and suppress the epidemic and the pandemic significantly so that the number of infections and serious illnesses would fall under the surge capacity in time, and buy you time to develop pharmaceutical interventions to complement this sort of non-pharmaceutical intervention, as it's called in the jargon. Okay, so now if we look around the world, what we see, I think, is a real pandemonium of results from these policies. So this is a slide of kind of a visualization that many people will be quite familiar with. And what it shows you is that although many countries have taken a kind of similar policy of lockdowns and sequestration, contact tracing, although there are differences in some countries, the differences in the rates of spread of the epidemic are very dramatic, right? Very significant. This is, of course, on a log scale on the vertical axis, and then you can see that some large countries, such as the United States and Brazil, have very large numbers of rolling and cumulative cases, and others, particularly China, obviously also a very large country and a very large population, and the original epicenter of the outbreak in the first place has come pretty close to viral extinction, although it is having some secondary waves. There are, of course, some doubts about the data and whatnot. We can talk about that to some extent if you want, but nevertheless, the story that emerges is that the epidemic levels and the rates of transmission are really all over the map in different countries. And there's no clear relationship between the number of cases and the stringency of the lockdowns that different countries have undertaken. So this is a scatter plot showing just that, lockdown stringency being measured by the Blavatnik School of Government Index at Oxford University. They've compiled an index that's generally comparable. It's not perfect, but generally comparable across countries. If you compare that stringency, the adoption of those stringencies across countries to the path of the epidemic, what you see is somewhat more encouraging in the sense that these policies are working, but they are quite different from country to country. And so the curves are flattening at different rates to differing degrees. And in some cases, I would say, particularly in the United States and United Kingdom, it's not clear that the curves have flattened or been bent in the way that they have in other countries, particularly in China and parts of continental Europe. And furthermore, you can see here that China, Italy, and France in particular maintained fairly high levels of stringency and even went up in their stringency after the curves had been flattened because of some of these secondary outbreaks. Whereas that has not been the case in the UK and in the case of the US, which are already starting to open, even though particularly in the United States, the curve has not been flattened and bent. As a final point on the pandemic, it's worth saying, of course, that there's a strong relationship between the age structure of the country in question and the rates of infection and mortality. There's also a significant relationship between the location of that country, right? The Northern Hemisphere appears to have been hit much harder than the Southern Hemisphere, although, of course, there are some doubts about the measurement in many countries. That generally seems to be the case. And of course, no surprise, with a few major exceptions, the larger the country, the larger the number of cases and deaths. Okay, so that's kind of the story on the pandemic. I'm going to switch now to talk a little bit about the economic impact of the lockdown. I'm sorry, the thing is going a little bit crazy here. Okay, so like I said at the outset, I don't see this as a recession or a depression in the conventional sense of the word. It's a compression, right? A deliberate decision has been made to compress economic activity. And so I think when we want to think about the historical benchmarks for this, it's worth thinking about what people actually mean when they say a V-shaped recession and recovery, when they talk about an L or a U or a W or whatever letter they ascribe. So here, what we've tried to do is to look at the Great Depression. That's the orange line in the bottom, and that's just the experience of the United States. The bright blue line in the middle is the experience of a number of Western countries that had a systemic financial crisis during 2008 and 2009, right? So the GFC, that's their median performance over time. So T is when the crisis or the recession hits and GDP bottoms out, except in the case of the Great Depression. And then T plus 1, 2, 3, those are years. The dark blue line at the top is, I think, this idea of a garden variety recession, a conventional recession that actually does have a V-shaped recovery. So what you're looking at here is the trend line of GDP. So it incorporates both the level of GDP and the growth rate over time. And so really what it shows you is that in a V-shaped recovery, there is no, in the conventional recession, there is no permanent loss in output. Whereas in the kind of stylized representation of a financial crisis scenario where the crisis is managed reasonably well, like in the GFC, even if it's managed reasonably well, there are permanent losses in output. And of course, in the Depression, those losses are very extreme, right? And were extreme. Of course, the Great Depression is not the only depression in US history. It's the most important one, but there were several depressions in the 1800s, many of which were known as the Great Depression until the next one came along. So I think it's quite important to be very clear about what the differences are here. In my mind, a recession, a garden variety recession, is one that is effectively caused by the central bank, usually the Fed. The Fed is a serial killer of expansions, and deliberately so. And I would say they're justifiable cyclicides, if you like, right? Because what the Fed is trying to do is to squeeze out excesses that show up in the inflation rate and overutilization of resources, capital, and labor in the economy. In the GFC, rather than tightening, the Fed loosened, and that helped to mitigate the recession that was caused by the crisis. Whereas in the conventional recession, like I said, the Fed deliberately creates the recession and then eases up. And because there are no balance sheet issues, the economy is able to return back to trend through the V and avoid permanent losses in output. In the Depression, and in the Great Depression in particular, I would say the opposite happens, right? The Fed or other central bank is incapable or unwilling to ease enough, and you get a series of financial crises or cascading defaults that really damage the financial system and damage the real economy, and you have permanent losses in output. Okay, so that's the background. Now, if we try to think about how this one is playing out, it's important to bear in mind kind of the obvious thing here, which is that every person, every agent, every economic actor's spending is somebody else's income. So if you compress everything all at once, everyone's going to be hit with the possible exception of the government, right? And so this slide just attempts to capture that circular flow of income and spending throughout the economy, and it illustrates where you get all kinds of hits from these lockdowns. So that's the story in a given economy. If we try to think about how much of activity around the world is being affected by these lockdowns, well, depending on the time you want to look at it, at this question, would say somewhere between 40 and, let's say somewhere between, let's say, close to a half to 4/5 of the world economy, perhaps 2/3 of the world economy, 3/4, something like that, depending on all the countries that are locking down at the same time, is being affected, right? So it is an absolutely enormous hit, and it's very quick. And so if we try to plot the relationship between the stringency of the lockdowns from that Oxford University Blavatnik School of Government Index, together with the Q1 GDP data that we have for a range of countries, what we see is that there's actually a fairly good relationship. It's not perfect, but it's strikingly good, I would say, that you have so many countries with such a different economic structure between consumption, investment, government spending, net trade, and yet they all reasonably close to this line of fit where, China had the most extreme lockdown for the longest part of Q1, and other countries had less stringent lockdowns for shorter periods, and yet they all went down very quickly along a similar line. So that is the recession in fast forward that comes from pressing that economic pause button in the lockdown. And of course, the result of that has been this financial panic in reverse, right? Because instead of this problem propagating from the financial system to the real economy, it's propagated the other way around, from the virus and the pandemic to the lockdown, to the real economy, to the sudden realization in financial markets that this thing is much worse than expected, and of course, a panic that resulted. And the Fed and other major central banks, developed and emerging, have thrown the kitchen sink at this problem, stabilizing the financial markets. Okay, so that's the backdrop there of the pandemic and the economy. Now let's think a little bit about the international system. So what you have here is an effort to try and represent a series of pandemics that have occurred over the last 100 years and even before that, right? And I think what stands out here is that the best precedent in many ways is probably the great influenza pandemic, or the so-called Spanish flu about a century ago, right? The reproductive rate, which is on the average number of people infected by each sick person, that's on the x-axis, and the y-axis is the fatality rate. The range of estimates early on for COVID were quite close to the range of estimates for the Spanish flu. Now, the Spanish flu, I think, is quite interesting because it occurred in the wake of World War I. And I would say, there were some major changes in the international system that resulted from the Spanish flu, some of which were random by chance, and some of which may be a little less random and maybe a little more telling for some of the geopolitical and geoeconomic changes that might arise. So the random change here is that it turns out that President Woodrow Wilson of the United States was one of the victims. He fell ill, and as a result, he could not participate in the peace talks for the Treaty of Versailles. And so by some accounts, the war reparations imposed on Germany as a result were much more extreme than they might otherwise have been, right? Because other continental European powers, particularly France, had a very strong presence in those negotiations that was not mitigated by the US, as many people would have expected under those circumstances. So that's kind of the random change that occurred. India suffered half the deaths in the Spanish flu epidemic or pandemic, and Gandhi was one of the victims, and he sort of lost his voice. But I think it's fair to say that by many historical accounts, he found even greater intensity in the struggle for Indian independence as a result, because of this quote-unquote imperial indifference to public health in India that resulted, right? So, it may be that the Second World War and the combination of this drive for independence that came both from this Spanish flu and the Bengal famine a couple of decades later led to Great Britain's role in the world being substantially reduced. Might have happened anyway, of course, but I think it's an interesting kind of factoid that there are major changes in the international system that occurred the last time there was a major pandemic that really affected the whole world. So this time around, what might happen here? Of course, it's very early to say, we don't know, but as a useful kind of framework, I thought of a book by Ian Bremmer, who's the head of the Eurasia Group, is a prominent political scientist, and also actually a stand-up comedian. If you happen to know Ian, he can be quite funny. But rather more grimly, he has developed this kind of idea of, or applied this idea of a kind of four-quadrant story of the world, depending on whether over time there's more cooperation between the United States and China, or more conflict, or a tendency towards greater conflict. And then, of course, the US and China are not the only actors that matter. It's really important whether other states assert their own national self-interest, in which case we might have something of a more multipolar system, and that when there is coordination, it's more or less a concert of nations, a kind of 19th century idea that you can get people around a table, issue by issue, or sometimes perhaps coincidentally organize things, but that much of the time you might have a multipolar system with spheres of influence and no real global leadership, right? That's substantially what happened as well in the interwar period. On the other hand, if other states are more cooperative, you could imagine that, you know, there's kind of joint leadership between the US and China in the cooperation scenario, or that we might get something, you know, that everybody talks about, this bipolar Cold War type of world that we've already experienced, at least in some respects, between the United States and the Soviet Union back in the day. So I think it's fair to say that, you know, the key issue here is the US election, and of course the response of China to that outcome and the response of other countries. And so if in the upper half of this chart, we might be in a more sort of, that might be a more Biden type of world, and in the lower half, it might be a Trump 2 type of world. I think it's important to say that the Cold War analogy is a bit misbegotten, in my opinion, because the US and China and many other countries are completely enmeshed. So it seems to me the idea of decoupling is very difficult to achieve, and it's nothing like the situation at the beginning of the Cold War when, you know, most of the world was decimated. The US was head and shoulders much larger than any other economy, and was able to do a lot of things that it cannot now do. And of course, Russia was cut off from the world, and much of the world, you know, Russia was also decimated, and much of the Western world was decimated. Much of the Asian region was also decimated. So a very different kind of situation. It's the obvious analogy to make, but getting into a Cold War situation where you have China autarkic and the US very heavily enmeshed with its quote unquote allies, it's easy to say. I think it's very difficult to do. But nevertheless, I think this is an important and useful framework to use for thinking about this. And I think the main message here is that it is clear, at least it seems clear to me, that this issue is going to be critical for the level and the distribution of global growth over time, and it may affect the cyclical recovery from the pandemic and the lockdowns. Okay, so with that, let's start to think a little bit about the recovery. I think the story that emerges here when you look at the policy response and look at the economies in question is one of enormous variety, right? Diversity, variegation in many respects. And so here to start with central bank balance sheets, the increase in the size of the Fed's balance sheet is just off the charts compared to its own history and compared to any other major central bank, as you can see here, right? We're heading towards a balance sheet for the Fed that could easily be $8 trillion, could be somewhere close to half of what 2020 GDP might be by the end of the year as we climb out of this hole. Far larger than the balance sheets of the Bank of Japan, ECB, and Bank of England, right? The other major central banks that are engaged in QE, which is quite a bit different because the BOJ's balance sheet has been meaningfully larger until recently. When we look at the fiscal responses, the headline numbers seem to suggest that, you know, everyone is throwing the fiscal kitchen sink at this problem. But actually, when you look under the bonnet, there's a lot more going on and a lot more variety than is actually obvious. So the first thing I would say here is that Germany's fiscal support is way off the charts at almost 50% of GDP. It's multiples of the US fiscal support. What's very similar between Germany and the US is the amount of direct discretionary fiscal spending. That's the dark blue in the bars here. It's, you know, above 10 in Germany and just below 10 in the US. It's probably going to rise further in the US. And then when you look around the world, what you see is that in Europe in particular, and also in Japan, there's much more emphasis on guarantees than there is on direct fiscal spending. And in the case of the US, there's much more emphasis on direct fiscal spending, right? So Europe and Japan are taking the point of view that maybe with the exception of Germany, they have much less direct fiscal spending space, but they have a duty and a need to underwrite the solvency of the corporate sector and indirectly the household sector by providing all these loan guarantees and deferrals, right? Deferrals on taxes and fees don't hit the fiscal accounts when they're made, only if they're defaulted upon. And the same thing with the with the loan guarantees. So there's a lot of state aid taking place in Europe, and there's much more direct aid to corporations and to households in particular in the case of the US. And we can talk about why it almost has to be that way in more detail if you want in the Q&A. You look across emerging markets and you see the same story, right? The headline numbers, India, for example, says that it's providing 10% of GDP. The truth is nowhere near that. It's closer to 1% of GDP because the 10 includes the central bank and includes a lot of programs that were designed in 2019 that had nothing to do with the pandemic. So there's much more respect, if you want to use that term, for the fiscal constraints and a lot more indirect spending, at least in some emerging market countries. So again, like the central banks, the fiscal policy support is a lot more differentiated than maybe the headline numbers suggest. Here's just a slide showing you that the economies are starting to bounce back through PMIs. Of course, those are diffusion indexes, so they don't tell you very much about the level, just that things are changing for the better, which I don't mean to minimize that. That is good news, but the level matters here. And one final consideration on the shape of the recovery, going back to the epidemiology, is that if there's a second significant wave that exceeds surge capacity, we may need to have quite wide lockdowns again that points to a double dip, a W kind of scenario. I would suggest that that's probably not likely to happen. Politically and economically going to be difficult to do in many of the large economies in the world. And I would suggest that we have built some surge capacity and we also know much more about the pandemic. So it's much more likely that lockdowns in the future will be much more targeted rather than generalized, right? Perhaps isolating regions as China is doing, or isolating the vulnerable rather than the whole country. And so, there is a risk of a depression and a W out of this. I wouldn't rule it out, but I would suggest, given all the fiscal support, monetary policy support, and the progress in dealing with the pandemic, that the depression scenario is a tail risk. So we've taken a quite, detailed look at, approach to try and be very granular about multiple scenarios of how this thing could play out, and tried to imagine what kind of scenarios would occur. And we think all of this alphabet soup is possible. None of it can be ruled out. But when we try to go through this effort, and you'll see that in a few moments, what we come up with through our imputed probability weightings here is what like I said, I call a square root shaped recovery, right? That we have a sharp downturn, we have a bit of a significant bounce back over time as pent-up supply and demand are released, but other kinds of constraints, balance sheet constraints, epidemiological and public health constraints, and geopolitical constraints come into play, geoeconomic constraints, and prevent the recovery from being that full-blown V-shaped recovery. We don't get the depression scenario either, and hopefully we'll avoid financial crises, but we will have balance sheet issues in the household sector, corporate sector, and in the public sector in some countries. So when we try to look at this across the world, and you'll see the model shortly, what we come up with across these scenarios is this fan chart that's in the upper right-hand corner of this slide. So the gray area, the dark gray and medium gray there represent the different scenarios. And I've put this in the context of the Great Depression, the global financial crisis, and that median experience of V-shaped recessions across hundreds of examples of short recessions in many countries over 200 years. Okay, so what you see here, I think the main message here is that what we expect in all these scenarios is something meaningfully worse than a garden variety recession, significantly better than the Great Depression, but perhaps worse than the GFC in the short run and better over the medium run than the global financial crisis. Right? And some of the details of the numbers coming out of this toy model and scenarios and shocks are there if you want to look at them later. Now, the theme here is that at the level of different countries, climbing out of this hole is going to be very different. And that is because the lockdowns have been different, the reopenings are going to be very different, and even more importantly, the structure of GDP is quite different across countries, right? So in this toy model, what we did was think, okay, this is very different. So the historical relationships don't necessarily tell us how this is going to evolve. And I think you're seeing that in the changes that are being made in the forecasts by many multilateral organizations, right? They started out by trying to be very granular about the existing models. So what we did, like I say, is we took a completely different approach and said, okay, what are, and we call it a toy model in this way that a former chief economist of the IMF has described this kind of model. It's just an effort to take a first pass at a complex question. The idea is not as much of a joke as it might sound like by calling it a toy model. It comes from physics, and many of the cornerstone models in macroeconomics are actually originally toy models. So what we did was we said, let's take a step back. What's the structure of GDP in each country? And we actually went to the CIA World Factbook to try and figure this out, or try and get estimates that are usable across countries of the components of GDP by end use, right? So government spending, for example, everybody would know government spending is very high in France, but a large part of that goes on wages. And so to make it comparable across countries, this is captured in C, the government spending that goes into the wages of public sector workers and is spent there. The government spending that is on investment goes into I, and then the operations of the government are in G. So we took a look at that, and we made shocks to different countries, and then reaggregated that, and that's how we came up with the global numbers across countries. And the shocks were based on these scenarios for how the economy might evolve and how the epidemiology might evolve, and therefore what that implied for the Oxford Stringency Index, using real Q1 data country by country, right? So Q1 is real, and then from Q2 through 2025, these are the scenarios evolving. And what it shows you is that there's quite a wide degree of variation relative to the baseline trend growth rate of each country, right? So China performs the worst here relative to its own baseline, which was the highest trend growth rate of any major economy at about 6. And India's the next worst because it was the second fastest growing major economy after China. And Japan is the best performer because it had the lowest trend real growth rate prior, right? So there's going to be a lot of variety here is the message, and it reflects as much the past, the shock of the coronavirus epidemic and the lockdown as it does about the future. I think it's worth thinking in this context about some of the geoeconomic and, if you like, geofinancial weak links here. So the Eurozone has been a key weak link. It's improved that situation through this, what many people are rather grandiosely, I would suggest, calling a Hamiltonian moment. There is some steps towards fiscal integration taking place, but it's far short of what Alexander Hamilton achieved for the United States hundreds of years ago. It is important because it's eliminating the risk of a disintegration in the short run, or at least reducing it significantly, but it's not eliminating sovereign credit risk, in my opinion, and that is what you see here. I think the middle chart shows you Eurostock's bank risk premium versus Eurostock's equity risk premium, and you can see that the bank risk premium has collapsed towards the equity risk premium in general, which I think is telling you that this step is being seen, this Hamiltonian movement, as we call it, is being seen as a signal that the bank sovereign doom loop is being broken. But the chart on the left-hand side shows you that Italy and Spain still trade at significant spreads, even though they've come into France and Germany. And that shows you that sovereign credit is still important. So disintegration risk has been reduced, almost eliminated, or at least managed way down for this crisis. But sovereign credit risk has not been. You look around the world and think about the capacity of different countries to continue the fiscal support, and it's extremely variegated. Public debt positions and fiscal deficit positions going into the crisis were very different, with emerging markets, of course, being in the worst position compared to developed countries. In many cases, developed countries had better positions and also, of course, have greater capacity to issue debt. So that's going to be a constraint for global recovery and recovery in many important emerging market countries, I would argue, let's say especially India, Brazil, South Africa, maybe less so Russia, maybe less so China because of the particularities of China. And of course, some of these differentiations are being reflected in a very differentiated performance in capital markets. And I think, it's fair to say that that will continue. So I'm going to skip ahead a little bit here. Just to put this in these yields across markets in historical context and in cross-section, you can see here that a variety of the risky assets have been supported mainly, I would say, by the actions of the Fed and what that's allowed other central banks to do. But there's still a high degree of variation, right? And what it shows you here is that real estate, I guess would be no surprise in a way, real estate is more challenged in a way with yields that are above average within their historical ranges, but above average compared to most other asset classes, which are in most cases below average and actually at the bottom end of their ranges in all kinds of debt asset classes, whereas equity clearly has a somewhat cheaper valuation in many cases. So a lot of differentiation and dispersion across asset classes, despite the fact that there's this kind of beta trade going on where everybody's buying the market because of the Fed. If we try to put all this together with our scenario analysis for the global economy, we would say that the market is more or less, in some senses, reflecting a lot of these tensions between the extreme degree of fiscal support and monetary support across the world, and the macro headlines that are implied by all these very different scenarios and great uncertainty. Those are just our scenarios and our estimation of what might be happening, but I think everybody's going through the same sort of process in different kinds of ways. So to summarize and conclude here, I would say that we have obviously much overused word, unprecedented shock. I would say the kind of framework most people are using, recession or depression, it's the wrong way to think about it. It's a compression. We've decided to shut things down and we're now deciding to open them up. So we will have a bounce back, but it'll be a constrained bounce back. So rather than being a V or a U, it's going to be, in my opinion, I'd like to think of it as a square root, right? Straight down, straight up, and then level off as these constraints come into play. It'll be a very highly differentiated recovery across countries and across sectors. And there will be probably major structural changes ahead in the international system, which will maintain that differentiation. Okay, so I've talked quite a lot. I recognize it's 1/4 to the hour, so hopefully there's some Q&A and discussion and debate, and we can disagree if necessary.
Well, thank you very much for that, Arnab. Definitely a very insightful presentation. So we have had some questions come in, but I just wanted to kick off with a bit more of a general question that speaks to a point that you raised earlier on in the presentation. And actually, just before I do that, for those of you who dialed in a bit later, you can raise questions directly via the Q&A function within the tab at the bottom of the Zoom call. So if you'd like to do that, feel free to do that, and we'll put those questions to Arnab. But one of the questions that I wanted to raise was in relation to this notion of lost output and a V-shaped recovery. So within the context of a recovery and projections that you put forward, is there, I mean, in your opinion, is there going to be lost output that's spread over specific sectors, specific industries? Can you speak to that in terms of in terms of lost output within the square root shaped recovery that you mentioned?
Mm-hmm. Yeah, I think it's already the case that is happening. And I think a lot of the kind of political economy phenomena that you see around the world, and particularly in the United States, points to that, right? I think, many of us on this call, I assume, haven't really missed a beat here. We've adapted very quickly to working at home. And so, those of us who can do our jobs in the let's say, perhaps in the high-end service sector or parts of the manufacturing sector, we have probably not lost much output or productivity. But others who are engaged in activities that are directly affected by social distancing or self-isolation, particularly lower value-added, let's call it lower value-added services, they've obviously been hit hard. Yep. And of course, this is in the case of the US, which has the most flexible labor market of any large economy in the world. That's why we've had this enormous increase in unemployment, although it's come in a little bit in the last release. Yep. been the reason for that. So I think on sectors, I think, you know, a lot of those sectors that are going to be slow to come back, everybody's talking about, and I don't disagree with any of that, right? I think hospitality, leisure, travel, tourism, some kinds of personal services, like, you know, hairdressers and so on. A lot of those things that are quite important backbones of employment, labor intensive, low value added, if you like, kinds of services will be quite slow to come back. And many of the businesses associated with those kinds of services would not be viable in a socially distanced environment if that social distancing has to be maintained even for a little while longer, a few more months or several quarters, and if it has to go back to that, right? Because a lot of those businesses are cash flow dependent, like restaurants and small scale businesses.
Sure. So just to build on that kind of point, one of the questions that have been raised is, do you think commercial real estate will take a hit due to working from home taking hold, irrespective of recovery? Now, granted, real estate is not your area of specialism. We're not expecting you to give a projection as to, you know, what landlords are going to do across the economy. But do you think that is likely to have a permanent impact? And more interestingly, do you think that is going to be priced in from an investment perspective?
I think that is indeed part of the reason why real estate has, in some sense, lagged, you know, the response in some other more financialized asset classes, right? Actually, at Invesco, we do have a quite an important quite a sizable real estate business, both in the financial markets and through direct investment. And this is a bit of a fierce debate that goes on in the firm. And I'm in the camp that suggests, you know, that says there will be some structural changes. I don't think we'll not have offices anymore. I think we will, but I do think those offices are going to end up being different. They're going to come back more slowly, right? Because if you think about, particularly in US cities and many other, you know, sort of densely urbanized locations, you have tall buildings with elevators that are difficult to use. So you have all kinds of issues that will slow down the return to the office. And then I think, you know, the fact that you can work at home will make some difference, right? The optimal size of the office, if it were 100% of whatever metric you want to use before this shock, it'll probably be significantly lower than that, or it could be significantly lower than that. And if we're right that there'll be permanent losses in output in general, then many businesses will need to find ways to cut costs in order to improve profits and returns for their shareholders. So I think, you know, there's going to be a lot of pressure in different sectors and in different parts of the world to reorganize their commercial real estate and some of their fixed cost activities. And that's one, you know, commercial real estate is one obvious area of that. And then of course there's the retail side, you know, maybe you need less bricks and mortar, a trend that was already underway, more online shopping and so on.
Sure. We've got a question here from Isabel. What do you mean by indirect spending in EM, which I believe was your slide to do with the difference between emerging markets and developed markets? And you're describing the difference between some of the direct fiscal spend versus guarantees.
Okay, yeah. So what is? Let me start by defining what is in the direct spending or the fiscal impulse, right? So the fiscal impulse there is, these are estimates of the spending that is beyond the impact of, or separate from the impact of, what are called automatic stabilizers. So when the economy slows down in most countries, you would expect tax revenue to fall and some increase even in many emerging market countries in unemployment related spending or spending that occurs automatically during a slowdown. So on top of that, there have been discretionary fiscal measures, and some of those are direct spending. That's the dark blue in both of these. Now, in the EM case, there are lots of different things that are being done and lots of different accounting techniques. So the IMF has tried to kind of normalize for all of that and thrown a whole bunch of different things that are indirect into the pot here. So there's no simple answer to that question, but I think the key thing is to say that the key message here is that the level of direct fiscal support is, number one, much lower than the headline numbers would suggest. And number two, it's much more varied across countries than the headline numbers would suggest, even allowing that there's a fair amount of variation in those headline numbers. And I think it almost has to be this way, because if you think of a private economy, a free market, a market economy, as opposed to a fully socialist economy, the public sector is only a fraction, by definition, of the private sector, of the corporate sector and the household sector and the financial sector, right? Mm-hmm. So it can only do this to some extent, provide all this support to some extent for a certain limited period of time. We could talk about modern monetary theory and all kinds of ideas about how you might finance this, right? But the bottom line is that you can't underwrite everything for an extended period of time without nationalizing it. And that's very unlikely to happen. It didn't even happen during the Great Depression. So the message here is that the fiscal support is a cushion for the compression. It is not yet in the form of a big stimulus. And so when you put together this story that the stabilization measures and the cushion is quite differentiated, as well as the available fiscal space is quite differentiated, it tells you a story of in my opinion, of a very differentiated return to growth, even as there's a return to best possible business as usual.
Sure. So just on that note, and granted, your response may be differentiated in response to this as well, but we've got another question here that asks: once the employment subsidies, within the context, I guess, of the fiscal intervention that you're mentioning, goes away, will unemployment rise? And if yes, will the impact be high or low? I think it'd be interesting to speak about this in the context of whether you think, to what extent you think private employers, private markets, are going to step in to fill that gap, and is it going to match what is currently being done?
Yeah, I think it's an excellent question. I would say I think it'll vary again, differentiated, as you said, Kenneth, across countries. The response in the labor market has been quite different. I don't have a slide of it here in this deck, but there have been a lot more furloughed workers in Europe than in the US, where there's been furloughing, but also a very large move to just reducing the workforce in many companies. So I think the response as this comes back is going to be quite different across countries, because the labor market is going to be shocked in very different ways. Now, coming to the question of if the fiscal support runs out before the economy really comes fully back, it's a big issue here in the United Kingdom and in other countries, but it's a big part of the debate here. I think the answer to that is, yes, that is going to be a problem. It may not be a kind of depression level problem that really constrains the economy to be at a very weak level, but it will constrain, in my opinion, it will constrain the rebound again to differing degrees across countries, because some of those furloughed workers can be brought back, but others, it may not be possible to bring them back, and still others, where unemployment has taken place, if we're right that they're going to be businesses that are not viable, they won't be, or they'll be, at least, while they're figuring out whether they're viable, and while their creditors and shareholders are figuring out whether they're viable, they'll be slow to hire back or to take people off furlough. So I think these are, a lot of the kind of headwinds that will be there. I think they will get, fiscal support, unemployment benefits. In the case of the US, they'll be extended. Maybe they won't be as large as they are now at $600 a week. They'll be extended, but it won't solve the entire problem, right? The private sector will have to do that over time.
Sure. And very timely, the next question we have, which was raised quite a lot in the as a topic area in the questions that were submitted before the event, is about inflation. The specific question is, will inflation will not be a problem over the next few years, at least in developed countries, US, UK, Germany, etc. Would you agree? But it would be great if you could, in answering that, also kind of address issues of inflation, particularly in relation to the unprecedented amount of government and fiscal stimulus as well.
Mhm. Yeah, so that's obviously a big debate, and a lot of people are saying that we will, with all this fiscal support and all this monetization, we will have a return to inflation. There's also a bit of a discussion that if we have the trade barriers and investment barriers going up between the U.S. and China, maybe between U.S. and other countries, and UK and Western Europe through Brexit, we might see a return to inflation from that source. And I think it is certainly a risk to bear in mind. I would not say that we're going to see very high inflation anytime soon. And I would say furthermore that if I'm wrong about that, and we do have moderately high inflation, that is a quality problem, because I think it's a problem that central banks know how to solve, right? What you do is you withdraw the stimulus and tighten monetary policy. And if you don't do that, the market will do it for you, right? Because at least in the case of the US, yield curve will steepen, and it'll cause a shock. If there's big inflation, upside inflation surprises, yield curve will steepen, it'll cause a shock throughout financial markets, it'll tighten financial conditions, and will slow down the economy if the Fed is behind the curve. If the Fed is behind the curve judiciously running the economy, quote unquote, hot to get the unemployment rate down, well, I think we've already seen how that plays out.
Sure.
And in a world where demand is constrained and investment is constrained, even investment, right, it's potential supply in the long run, but it's also demand in the shorter term, right? Because you hire workers, you build stuff as you invest. I would say, inflation not going to be a problem, not just in the short term, but in the medium term, right? Because of all of these kinds of constraints.
Great. And there's a question here from Julio, I think, and apologies, Julio, if it seems like you raised this question a bit earlier, but it's coming at the bottom of my list for some reason. And it's about a second wave, Arnab. And the question is specifically, what are the assumptions used when considering a second wave of the pandemic? Does it include national lockdown or just regionals? And if the second, are we not already in this scenario? And I think it speaks to some of your projections in terms of also the impact potentially of a second wave and how that might be mitigated by what we've learned from the first.
Okay, so we did consider a significant second wave in this worst case scenario in the lower right corner. We gave it only a 5% probability, not because we were trying to say that there was going to be a 5% probability of a significant second wave, but that we don't think that there's a high probability that we'll have the same kind of aggressive economy-wide lockdowns that we had with the first wave. And the reasoning there is that we have built some surge capacity, right? Temporary hospitals, more capacity to produce and transport personal protective equipment, testing, tests, treatments are coming online. We'll see how effective they are, and so on. And so what we thought was that maybe there's a meaningful chance of a second wave, but that the way we would deal with it through these non-pharmaceutical interventions would be not to lock down entire economies, but to target the lockdowns. And so we gave the economic impact of that severe W-shaped double dip that looks more like a depression, only a 5% probability. We didn't take a probabilistic view on the likelihood of the second wave.
Great. I think we're almost at time, Arnab. I'm happy to go for a few more minutes if you'd like to take one or two other questions, if that's fine with you.
Yeah, that's fine. If people
Great. So one of the other questions that we've had is generally about investor sentiment in emerging markets, and I think it's. Essentially, it's where is the smart money sitting now in the current climate, and are you seeing investor sentiment in emerging? How are you seeing an impact on investor sentiment in emerging markets?
I think, like in many corners of the markets, there's been a lot of head scratching going on. I think people are, reluctant. I guess many, quote unquote, professional investors are reluctant longs in many asset classes, right? Or have been reluctantly covering their shorts or underweight, depending on what kind of investor they are. Mm-hmm. And I think that applies to the EM space as well. I think, one of the conclusions that's being drawn here is that, interest rates are going to remain very low because the economy is under such compression, and because the recovery will tend to be maybe, not such a V-shaped recovery. We've had this V-shaped recovery in the financial markets because the Fed and others are throwing the kitchen sink at this problem. So if we're in a highly monetized, very low growth, very low inflation, therefore very low yield world, it makes sense to extend duration, extend credit, extend equity, and extend into emerging markets for those higher yields. Sure. So I think that's what's going on, rather than a high conviction that EMs are going to bounce back very strongly.
Sure. And any thoughts, Arnab, on how you think the current crisis will affect, two sides to this, how it'll affect the perceived trend towards localization of supply chains, and how that's going to kind of affect economies and kind of attractiveness of certain investments overall?
I think that's going to be one of the consequences of this, change in the international system. It's hard to know exactly how it's going to pan out, but I would suggest that we will have a degree of diversification of supply chains, and this whole buzzword of resilience in production processes and inventory management, right? So, buzzwords are to move from just in time to just in case, and also to have less concentration risk in the supply chain. Now, I think that is, a lot of those things were already starting to happen. Originally, because China was becoming a higher cost location, China in particular, to do business, make stuff. So lower value added stuff was moving to Bangladesh, India, Vietnam, high labor surplus countries with low wage costs. So there was originally kind of economic pressure of a corporate performance pressure reason to do that. Then you had the trade war, which gave you kind of a geopolitical, geoeconomic reason to do that. And now there's kind of a risk management, if you like, a risk management reason to do that, plus the kind of geopolitics and geoeconomics. So I think some of those changes are going to occur, have already been occurring, are going to be strengthened as a trend. But having said that, I think that, there's not likely to be a kind of, sudden dramatic rupture, despite all the saber rattling from Washington. I think the saber rattling will continue, and I'm not trying to dismiss it as noise, but I do think that these decisions are going to be made in the private sector, taking cues from what the new policies are, but in the fullness of time, in the cold light of day, right? Not in the heat of the campaign, not in the heat of the blowback for the pandemic. And I think, people will continue to take the view that, we can't put all our eggs in one basket anymore. And I think that's, partly about China, but not just about China. It's also about the United Kingdom, right? After Brexit, you said, well, we're going to move some stuff into continental Europe, so that we can get into, be involved in Fortress Europe and keep some stuff in the UK. And then when you look in Europe, you say, well, you have, Macron. It wasn't Le Pen, but she's still there. You have all these different tendencies going on, so you might try to spread, some of your risk and some of your production structure around in the real sector, just as you would diversify your portfolio in the financial sector. So I think there's going to be a lot more of that, but it's going to